Hey guys, Brian here. Hope you're having a great week. In this video, I'm going to talk about this chart of corporate bond yields in the US, which have been making some truly historic moves to the upside lately. I'm also going to talk about a concept in bonds called duration. It can be a little bit of a tricky concept, but it's important to understand how duration affects bond prices, especially in an environment where interest rates are rising. So it should be a pretty quick video. Let's get to it. All right guys, welcome back. I'm here in Florianópolis, Brazil. This area is called Lagoa da Conceição. I think I'm pronouncing that right. Apologies for my terrible Portuguese, but Floripa is one of my favorite cities in Brazil, and Lagoa is probably my favorite area within Floripa. We're on the southern coast here, so we're south of Rio, south of Sao Paulo. It's a really beautiful area, very kind of laid back lifestyle. It's almost got sort of a hippie vibe. There's a big lagoon that sits in the center of the island. Kite surfing is hugely popular here. You've got regular surfing on the beaches, which are beautiful, and there's a ton of great hikes all over the city. I'm going to turn my camera around here and show you. This is Morro da Lagoa, and it's a launch point for paragliding and hang gliding. I work at a co-op office on nice days up on the corner here, and you can watch hang gliders taking off from the mountain. So yeah, Floripa, one of my favorite spots. Highly recommend. There's a great community of digital nomads here, and it's just a great spot to work. All right guys, let's get into this chart of bond yields. We actually published this chart in July of 2020 when yields were at a record low, and our premise 2 years ago was that bond investors were taking on this massive amount of risk. We said there has never been a time in history when there's greater risk of loss from rising rates. So what led us to that forecast? That's where this concept of duration comes in. Duration is super simple, just measures how sensitive bond prices are to a particular move in interest rates. Higher duration equals higher risk to bond prices when rates are rising. Back then, duration had pushed to a record of about 8.5 years, so there was massive risk for bond prices. And so if we update this chart, you can see why we were screaming about duration risk 2 years ago. That blue line is up to about 3.5% now. This is a big move in yields. And of course, prices move opposite to yields. So corporate bonds have lost a tremendous amount of value since our forecast. Now, where are interest rates heading? We think we're still very early in this trend. In fact, most of the value in corporate debt has been lost in just the last 3 months. Some of the statistics are amazing here. If you look worldwide, corporate bonds down more than 1 trillion in the first quarter of 2022, biggest decline in at least 20 years. If you look in the US, March was the worst return for treasuries in over a decade. In Europe, the bond market got hit so hard that negative yielding debt is now at about 2.5 trillion. That's down from over 18 trillion just a few years ago. So this year has been brutal for debt investors, but we actually think it's still early in this trend. Investors are still purchasing debt with low yield or negative yield, and this is a reflection of pervasive optimism that really exists throughout most financial assets. All right guys, thanks for watching this video. I'm starting to get rained on here. So one final note before we go. Rising interest rates, they're not just going to affect bond investors. They're going to affect stock investors, real estate investors. Virtually every corner of finance is going to be affected by rising rates. So stay tuned. We're going to be hitting a lot of the trouble spots in future videos because investing in this environment is going to be entirely different from what most people are used to.